markets being okay with bad data to actually being impressed by data? Are we getting there yet, or is it still going to be ugly?
I think it's a little bit early. I think everybody, all professional investors understand that the data is going to be terrible, for the foreseeable future. I think if we're looking for some kind of understanding of what the summer looks like in the U.S., I think our best guide will be Asian data. Countries where lockdowns have been reversed, several weeks ago. It's not perfect comparisons. But so far the domestic data in China, is reasonably encouraging. It does look like their domestic demand, has recovered quite strongly. I'd say the same in Korea. In the U.S. stuff, it doesn't. April's going to be absolutely horrible. And May is going to depend on the pace with which various states start to reopen. So we're in a bit of a blind spot as far as information is concerned. The market is in that situation. I think has made some assumptions that this is transitory and that we'll come out the other side. But I'd be surprised if that optimistic viewpoint is enough to take the market through key resistance and up to highs.
That's kind of where it seems that we're at, Michael, which is the market going from pricing in a survival, which seems totally reasonable and I think should have been expected given the quickness of the policy outlay. But now it's almost like markets are pricing in, thriving on the other side of this thing, like we're going to net positive in some way. Does that make sense to you that we have valuations where they are?
And I think overall the U.S. market is expensive. I think global markets, it's not so true. Asian market is not so true. But I think even within the U.S., the expensive sectors are the more defensive sectors. Cyclical sectors are expensive if we're in a recession, and are reasonably priced if we come out the other side. So as I say, although my guess is that the overall index is range bound, I think what we would look for is whether or not the defensive sectors are getting the upper hand, in which case I think investors are staying in the market but getting more defensive, or whether the cyclical sectors are getting the upper hand. Last week, the cyclical sectors, really had a pretty good week. So I think sector performance is probably more important than overall S&P performance. I'd put technology to one side as something of a special case, and you really want to see the battle between utilities and real estate as classic defensive sectors versus, say, energy and materials or industrials as sort of classic cyclical sectors. And none of those sectors are so large. They're all a few 100 basis points of the S&P as a whole. So relatively small amounts of redeployment of capital can have an outsized effect on sector performance. And that's really the battle that we pay attention to if, as we expect, the overall index gets stuck in a range-bound consolidation.
What needs to sort of come to fruition here in terms of the speed of the data improvement or the speed of the viral curve going lower? Do we have a short time frame to justify where equities are before investors start to get worried again? I mean, are we skating on thinner ice the longer equities stay here without a clear path towards employment coming back?
I mean, obviously, yes. We've seen a very big shift in the medical situation. The medical situation has gone from sort of panicked and potentially tragic. I guess it's still tragic. It's just not as tragic as it looked like 4 weeks ago. And I think you do now start, you need to see a steady progression of opening, and that opening being managed effectively. So again, the US is somewhat behind Europe. It's 2 to 3 weeks behind Europe. It's 6 to 8 weeks behind Asia. I do think we watch what happens outside of the US and then watch what happens within the states which have been less effective in the US and to the extent to which they reopen. I mean, my assumption is still that we are going to be able to get manufacturing capacity back up and running. You are going to be able to get home building in the sort of key parts of the country, which just by luck are the areas which are not the most effective. The West and the South I think you're going to be able to, to get that activity up and running. And where I would be much more pessimistic would be a city like New York, which still looks to be weeks/months away from normalizing. And the only good thing you can say about that is that the sort of activity which is being crushed in New York is not that important to the S&P 500. The large service companies will be able to keep going on a work from home basis, and the small and medium sized enterprises, the restaurants and so on and so forth, as I say, as awful as it is to see that part of the economy go through what it's going through, it's not directly represented in the S&P 500 to any significant degree.
Michael, in your note this morning, you point out the City Economic Surprise Index, which had a pretty wide beat relative to expectations last week on the employment print. We've seen some of these numbers continue to cause relief in markets, which suggests even if they don't register as a beat based on the estimates, that maybe some of the whisper numbers are for even worse than what we're getting. And I want to combine this with a point you had in another recent note, looking back at the prices paid element that we got on May 5th. You pointed out that the deflationary pressures here are not necessarily maybe what people expected. You said that there's an absence of deep deflationary pressures accompanying this collapse in activity. I think it's a really key point because so many assume this is going to be hugely deflationary. If there's an absence of deflationary pressures relative to expectations, is there a possibility that there's a presence of inflationary numbers down the road?
Yeah, I mean, the short answer is yes, because I think what we see is that it's not just a complete collapse of demand, it's also a massive disruption to supply chains. And so where demand is present, it's very, very difficult to supply the goods and services at the sorts of prices that we were supplying before. And the sort of big shift in activity from work to home is going to be a part of it. So if in the second half of 2020 we do start to see recoveries of demand, my assumption would be that the recovery of demand is going to be quicker than our ability to unwind the disruption to supply. And I think that is likely to be inflationary. Now, the degree to which we see it in CPI is going to depend tremendously on which prices go up, because all CPI is a weighted basket of various prices that the statisticians think in normal times represents inflation. It may be that we see large weighted items go up a lot, in which case CPI would really accelerate, something similar to what you saw in China when swine flu infected the local pig herd. It may be that the prices that go up are not that important, and not that visible in the baskets, in which case we won't see it in CPI. But I do think that you're going to see some corporate margins expand, some corporate margins contract. I think where you do have potential for margin expansion is going to be in commodity production. If we do start to see a sort of continued firming of some of the industrial metals, that's a sector that might come out of this in a sort of strange way as a price maker rather than the kind of price taker it's been for much of the last decade.